Today's our topic for SIPA is Murabaha and Murabaha to the purchase order under the heading of Financial Accounting Standard number 2. We'll cover following headings: the scope of the standard, accounting treatment of Murabaha, Murabaha to the purchase order, measurement of asset, valuation at acquisition by the bank, measurement asset valuation after acquisition by the Islamic Bank, Murabaha receivable, profit recognitions, deferred profits, early settlement with the deduction of part of profit, insolvency, failure to the purchase order to fulfill his promise, having paid hamish jizya, disclosure requirement and effective date. Next under this standard is adaptation of the standard, which includes brief history of the preparation of the standard, juristic or fake rules for transaction of Murabaha and Murabaha to the purchase order, reason for the standard, what was the reason for the standard and basis for conclusion and definition. Firstly, we will like to start what is the preface. This standard aims at the setting out the accounting rules for recognizing, measuring and disclosing the transactions of Murabaha and Murabaha to the purchaser order that are carried out by the Islamic Bank and financial institution. The standard also provides detail of fiqh principles on which development of the proposed accounting treatment is based. But you can say what is the basis on which this standard came into being. And it also highlights and different accounting alternatives which have been considered and justification of the alternate reason chosen for the accounting treatment of Murabaha and Murabaha to the purchase order. First of all, I would like to discuss the scope of the standard. This standard shall apply to the asset available to the Murabaha and Murabaha to the purchase order. The revenue, expenses, gain and losses attributed to such an asset as well as Murabaha receivables. This shall apply whether the Islamic Bank buys this asset exclusively from its own fund or from pool of management which were deposited in the bank only for purposes of certain purposes or uncertain purposes, or how Islamic Bank can use it. Should the requirement of this standard contradict with the Islamic Bank's charter or laws or regulation of the country in which it operates, and the Islamic Bank had to comply with such requirement, a disclosure should be made of the contradiction. Number 2, accounting treatment of Murabaha and Murabaha to the purchaser. First thing is the measurement of asset value at the acquisition by the Islamic Bank. Financial accounting statement number 2. Concept of Islamic accounting for the Islamic banks and financial institutions stipulate that historical cost shall be the basis used in measuring and recording the asset at the time of acquisition thereof. Therefore, the assets possessed by the Islamic Bank for the purpose of selling them on the basis of Murabaha or Murabaha to the purchaser shall be measured at the time of their acquisition on the historical cost basis. Number 2. Measurement of asset value after acquisition by the Islamic Bank. In case of Murabaha to the purchase order, who is obliged to fulfill his promise? Assets available sale after acquisition on the basis of Murabaha to the purchase order, who is obliged to fulfill his promise shall be measured at their historical cost. In the cases where the asset value declines below cost, whether due to damage, destruction or from other unfortunate circumstances, such decline shall be reflected to the valuation of the asset at the end of each financial period. In case of Murabaha or Murabaha to the purchaser is not obliged to fulfill his promise. If the Islamic Bank finds that there is an indication of possible non-recovery of the cost of goods available for sale, in this point, this standard explains if purchase order, that means a customer is the bank, if bank feels that customer is not obliged to fulfill his promise, then bank will will calculate on net realizable cash equivalent value rather than cost equivalent. Second point clarifies that if bank thinks that purchase order, that which means customer is not obliged to fulfill his promise, assets should be must be measured at the cash equivalent rather than the cost, and this shall be achieved by creating provisioning for decline in the asset value to reflect the difference between acquisition cost and the cash equivalent value. Thirdly, potential discount. If bank gains a potential discount, what would be the treatment suggested? Most of the Sharia advisors say that such discount should be passed on to the customer. However, if bank want to take into the revenue, the Sharia advisory board of said bank will decide about its recognition as a profit or it will be returned back to the customer. In second circumstance, in 2.3, Murabaha receivables. Murabaha receivable for short-term or long-term transaction shall be recorded at the time of occurrence. At the time of occurrence at their face value. Murabaha receivables are measured at the time of end of the financial period at their cash equivalent value. Amount of debt due from the customer at the end of the financial period less any provision of debt. If any provision of doubtful debt is credited, then this should be subtracted from the amount of receivable. 2.4, profit recognition. How we recognize profit in this standard? There are two methods. First of all, in proportion allocation of one of the school of thought or one of the school of thought, if we have to recognize profit as and when installment received, we will take into the revenue unrecorded. On the other hand, other figure says that proportional allocation of profit over the period of the credit, whereby each financial period shall carry its portion of profit irrespective whether or not cash is received. This is preferred method. However, since second method, lot of people of supervisory authorities says that as and when installment are received, this method shall be based on the decision by the Sharia advisory board of such respective bank. In both above, revenue or cost of goods sold shall be recognized at the time of concluding the sale of contract, subject to the deferral of profits. Deferral of profit we will make at the time of Murabaha, at the time of date of creation of Murabaha, we recorded profit, but we will not included all of the profit into the income statement. Only our deferred profit kept aside, and on the date of recognition, the deferred profit shall be offset against Murabaha receivable in the statement of financial position. Most of cases, as everyone knows that in point, I would like to explain to point 6. Most of the cases, in Murabaha, on the date of execution of Murabaha, profit amount is fixed for the certain period. If someone is willing to pay before maturity date, so it is a discretionary power of bank to take whole profit and return by way of gift to the customer. On the other hand, customer has no power to has no ethical power to demand refund of profit. It is the absolutely discretionary power of bank to give profit part to return back to the customer, because the basic principle of the Murabaha to declare and offer an acceptance, in which we declare what would be the cost and what would be the profit and what would be the Murabaha price. it is irrespective of the due date. Customer has to pay the Murabaha price return back on due date. If customer will pay early, before the will pay early Murabaha, he is not entitled to receive early settlement. But however, some of the jurists or fiqh scholars say that we can refund some part of profit to the customer. This 2.6 state how we treat the return of the early settlement of profit to the customer in their books. If a client explain the Islamic Bank may deduct part of the profit to agreed upon between the Islamic Bank and the client at the time of settlement. That the deducted amount shall be credited to the Murabaha receivable account and excluded from their profit recognized in respect of installments.